Have you ever looked at a financial statement and realized a crucial piece of information is missing, leaving you scratching your head about what to do next? Well, that very situation can arise when you sell investments and need to calculate your taxes, specifically if you do not know your investment cost basis. If you do not know your investment cost basis, you risk paying more in taxes than you actually owe, because the Internal Revenue Service may assume your basis is zero. This means they will treat the entire sale price as a taxable gain, leading to a much larger tax bill. It is essential to actively try and determine this value to ensure accurate tax reporting and to protect your financial bottom line. Your cost basis is simply the original price you paid for an investment, plus any associated costs like commissions or fees, adjusted for things like stock splits or dividend reinvestments. It is important because it is subtracted from the sale price to determine your capital gain or loss. A higher cost basis means a lower taxable gain, and ultimately less tax owed, while a lower cost basis or a missing one can significantly increase your tax liability on profitable sales. To figure out your investment cost basis, your first step should be to contact your brokerage firm or financial institution where the investment was held. They often keep records for many years and can provide you with statements showing your purchase details. If that does not work, look through your personal records for old transaction confirmations, account statements, or annual tax forms like Form 1099-B, which sometimes reports basis information. For older investments or those where records are truly lost, you might need to use publicly available historical price data as a last resort, but this can be complex and may require supporting documentation if questioned by the Internal Revenue Service. If all efforts fail and you absolutely cannot determine the cost basis, the Internal Revenue Service generally defaults to a zero basis, meaning the entire sale amount is considered profit. This is rarely the best outcome for you. Understanding cost basis also opens the door to more advanced tax strategies. For example, when selling portions of an investment, you can often choose between the first in, first out method, known as FIFO, which assumes you sell the oldest shares first, or specific identification, where you select which specific shares to sell. This choice can significantly impact your capital gain or loss depending on which shares have the highest or lowest basis. This level of detail helps you minimize your tax burden. Ultimately, accurately knowing your investment cost basis is a powerful tool for minimizing your tax obligations and correctly reporting your investment gains or losses. Keeping meticulous records from the moment you make an investment will save you time, stress, and potentially a significant amount of money come tax season.